I have had the hardest time trying to get this video together for you. The first one that I uploaded was only partially done. I don't know how that happened, but I've got it together now. I hope, I pray. So anyway, before we go on talking about the different ways that you can diversify your portfolio, it's important for us to clear up some simple terms, some terms that are used often that you have seen many times and may have experienced confusion with. So just like when we were in elementary school, we're going to start with the ABCs, okay? The first term that we're going to cover is an annuity. And what that is a series of payments made over time, and it's often used for funding retirement income. The next is APR. That is your annual percentage rate. That is the charge that you are paying. That is what you are, the cost of the loan for, like maybe credit, your car loan, your mortgage, whatever. And that focus on simple interest. Now, the next one is APY. That is your annual percentage yield. And that is the yearly return on your savings or investments. And it includes compound interest. And compounding interest excites me. And I think once you understand what it is, it will excite you too. So we will go over that and I can't wait. But for example, a savings account with a 5% APY, annual percentage yield, earns more than one with a 5% APR because the APY is including compounding interest, while the APR only has simple interests. Okay? So the last is assets. Many people confuse assets and liabilities, and we are going to clear that up for you so that you are not one of those people, but not at this moment. I'm just going to tell you what an asset is. And an asset is anything that you own that has value. So that looks like cash, investments, property, jewelry, whatever it is that you can use to get cash on hand is an asset. All right, we are back with the letter B for financial terms. And the first one is kind of a bad word for some of us ladies. We don't like to hear it, and that is the word budget. However, a budget is just simply a plan for managing your income and expenses. It doesn't have to be anything overwhelming or tedious or hard, or it doesn't have to be any of those negative things. A budget is simply a tool to help us realize where our money is coming from and going. That's it. A bear market is a period of time when stock prices are falling. So that's essentially when you want to pick up stocks on clearance. I like that idea. And the other term is a bull market. And a bull market is when the stock prices are beginning to rise. So that is not when you want to buy. This is when you're looking at wanting to sell. You want to get the most profit from what you bought. So you're wanting to wait until you get the highest price. That is the bull market. All right. So just to quickly recap, B is for budget. It's not a bad word. It is just a plan for managing your money. It is also for bear market, which is when you can pick up stock prices on clearance. And a bull market is when you want to start looking at selling your stocks.
All right, so we have a lot to go over today when it comes to the ABCs of wealth. I'm going to be using my notes a lot. The first letter that we're going to start off with is C, and that is for capital. So capital is basically money. It's your money or your assets that you use to invest or build wealth. So, for example, starting a business with $10,000 is using capital. Now, compound interest is the next term, and that is interest earned on the initial amount plus previously earned interest. So, for example, if you have an account with 5% APY, remember that's annual percent yield, and you've got $1,000 in that savings account, after 1 year, that account will grow to $1,051, and the year after that, you will earn interest on that 1,051, and so forth and so on. So compounding interest is really helpful when it comes to growing your wealth. The next is credit score, and this is something that we have all heard about, and it's basically a number between 300 and 800 that shows your credit worthiness. So a score of 750 means that we are more likely to get a loan that is low interest, whereas if you've got a lower score, the interest rate is going to be more. So you are essentially paying more to borrow money if you've got a lower credit score than if you've got a higher one. So now we're going to move on to D and talk about DTI, or your debt to income ratio. And this is your monthly debt divided by your income. So for example, if you earn $5,000 and you pay $2,000 in debts, your DTI is 40%. So it's really important to keep your debt to income ratio low and under control. Diversification is spreading investments across different asset types. So for example, if you are investing in stocks, then you want to also look at investing in bonds and real estate and other ways, so that your money is not all tied up in one sort of investment vehicle. It mitigates risk that way. Dividend is a company's payout to shareholders. So, for example, if you own 100 shares of a stock with a $2 dividend, you will get $200 annually. So, dividend stocks are really cool because they're just constantly paying you out. It's a nice way to have a passive stream of income. Now, equity is ownership in an asset after subtracting the liabilities. So if your home is worth $300,000 and you owe $200,000, your equity is $100,000. And then we've got expense ratio, and that is the fee for managing an investment fund. So that is expressed as a percentage. And for example, a 1% expense ratio on a $10,000 investment costs $100 annually. An ETF is an exchange traded fund, and that is a fund that tracks an index or a sector and trades like a stock. So, for example, an SPY is an ETF that tracks the S&P 500, and I know that sounds complicated, and I'm not super well versed in stocks, so that is the best example I can give you. I can get more in depth with that later and really come up with a succinct example for you. And we're going to close this out with F, starting with the FICO score, and that is the most common type of credit score. So for example, lenders use your FICO score to decide whether or not to approve a loan, and that goes back to your credit score. It's basically the same thing. And we've got fixed rate, and that is an interest rate that remains constant over a loan term. So for example, a 30-year fixed mortgage at 5% keeps the same rate for 30 years instead of a variable rate, which will go up and down, or normally just up. A 401k is a retirement savings plan that is often offered by employers, and they can sometimes match your contributions. So, for example, contributing $5,000 annually to your 401k might earn a $2,500 employer match.
Going to jump right on in with the letter G. So the first one is gross income. And I know that this one can be really confusing. And your gross income is just your total income before taxes. So if you make $60,000 a year per your employment contract, that is what your gross income is. So the one that this is often confused with is net income. And I've got a really silly way of remembering it, but it works for me. It's really gross how much money you think you're making, and you need a net to catch you when you find out how much you really are. So, like I said, it's silly, but it helps me. The next is growth stocks, and those are the stocks that are likely to see higher rates of growth than the average stock, and that typically looks like tech stocks. So moving on to H, we've got HSA, which is a health savings account. And that is a tax advantage account that you use for your medical expenses. So you set aside this money for maybe your prescriptions or an unplanned emergency, and that is what the health savings account is for. The next is HYSA, and that is a high yield savings account. So typically savings accounts will give you about 1%, and that's if you're lucky. But a high yield savings account will give you maybe 3, 4, 5 upwards in percentage. So that just helps your money to grow faster. So you really want to look out for those high yield savings accounts and take advantage of them. The next is the letter I, and we've got the index fund. So an index fund is a fund that tracks a specific market index. So for example, a fund mirroring the S&P 500 invests in the top 500 U.S. companies. Now, the next is the one that we are all uncomfortably familiar with, and that is inflation. And inflation is the rate at which prices increase over time. So, for example, in the year 2000, you may have spent $1 on a loaf of bread, whereas now, 25 years later, a loaf of bread is like $5, $6 maybe in some places. So inflation just cheapens the value of the dollar. The next is a joint account, and that's just a basic savings account or whatever that you hold with another person or a number of people. So as a mom, I have joint accounts with all of my children so that I can transfer money into their accounts. And when I was married, we had a joint account for the bills. So that is what that is. Moving on to the letter K, we've got K1 form, and that is a tax document for income earned from partnerships. So if you are in business with someone, at the end of the year, you will receive a K1 to report your income. Now, next we are on to liabilities, and liabilities are debts or obligations that you owe. So for example, if you have a car loan, that car is not an asset, it is a liability because you still owe on that. Credit cards are liabilities. Your home until it's paid off is a liability. So anything that you owe money on is a liability. The next is liquidity. So liquidity just is how easily you can cash out an asset. So your savings account is highly liquid, whereas your home may not be because you have to put it on the market. You have to wait for somebody to make an offer. It's not going to be something that you can just cash out the next day like a savings account. So that is liquidity, just how easily you can assess an asset's value and convert it to cash. Moving on to the letter M, we've got mutual fund, and that is a pool of money from investors used to buy stocks, bonds, or other assets. So for example, a mutual fund may invest in a mix of U.S. and international stocks. So on to the letter N, we are at net wages, and that's what we talked about a while ago, and that is your take-home pay after taxes and deductions, okay? So that is gross minus your deductions is your net. So for example, if you make $60,000 a year, which is your gross wage, and $15,000 is deducted for taxes, your net is $45,000. So your net worth is your assets minus your liabilities. So for example, if you own $500,000 in assets, but you've got $200,000 in debt, your net worth is $300,000. And we are going to stop at the letter O with opportunity costs, and that is the benefit you lose by choosing one option over another. So for example, spending $500 on a TV instead of investing that $500 is an opportunity cost. All right, let's jump right in and close out the ABCs of Wealth series, starting with the letter P. So a portfolio is a collection of investments. So that could look like stocks, bonds, mutual funds, real estate. Anything that you have builds your portfolio. Now, principal is the next term, and that is the initial amount of money borrowed or invested. So if you are investing $1,000, your principal is $1,000, same as if you're borrowing it. It does not include any interest or fees, okay? Next is quarterly earnings. So if a company profits X amount of money over a 3-month period, at the end of that 3 months, that is when the quarterly profits will be shared with its investors. A Roth IRA is a retirement account that is funded with after-tax dollars, offering tax-free withdrawal. So that's really important to know. And the example of that is if you contribute $6,000 annually to a Roth IRA, it grows tax-free. Then we've got stocks. So a stock is simply a share of ownership in a company. So if you were to buy Apple stock, for example, and that stock grows, the company's value grows, so does your ownership in that company. So that's how you're able to make money with stocks. Conversely, if the value of the company goes down, so will the value of that stock. Then we've got savings rate, and that is the percentage of income saved. So if you are saving $1,000 out of your $5,000 paycheck, your monthly income, your monthly savings rate is 20%. Then we've got tax deduction, which is an expense that lowers your taxable income. So if you are donating to charity, that will reduce the amount of taxes that you are responsible for paying. Then we've got underwater mortgage, which I hope none of you ever experience in life, and that is owing more on your mortgage than your home is worth. A lot of us experience that with cars. If you buy a car right off the lot, it immediately depreciates, especially if you have financed that car. Now you have paid more for that car than that car will ever be worth again. So that's something we want to stay away from. So moving on to V, we've got volatility, and that is the degree of variation in an asset's price. So cryptocurrency, for example, experiences a lot of volatility in its growth and whatnot. So, for example, you could buy the cryptocurrency for $5,000. Maybe in a week it's worth $10,000. The next week it's worth $2,000. So it just goes up and down. There's really no predictability behind it. And then we've got wealth, which is my favorite word. And that is the total value of assets minus your liability. So your wealth, if you remember the term net worth, these are synonymous. The calculation to figure out what your wealth is the same as your net worth. If you owe $1 million in assets and if you own $1 million in assets, but you have $200,000 in debt that you owe, your net worth or your wealth is $800,000. Now to the last term, we've got yield, and that is the income earned from an investment, usually as a percentage. So for example, a bond yielding 5% pays $50 annually on a $1,000 investment. So I hope that this series helped you figure out some financial terms that may have been causing confusion, and the next time you hear them, you have a little bit more clarity. Okay, so like I mentioned before, you can find me almost on any social network. I'm on Facebook, Fanbase, obviously TikTok, YouTube, and Substack. Okay, so until next time, have a great day.